Introduction. The global financial crises that have occurred over the past century have left profound marks on the global economy, from the Great Depression of 1929 to the 2007 and 2008 financial crisis. These events not only caused significant economic disruption but also exposed the vulnerabilities and weaknesses inherent in financial systems worldwide. In addition to the economic effects, financial crises often lead to social upheaval, political instability, and a shift in global power dynamics. Understanding the root causes of these crises, their impact, and the lessons learned from them is crucial for policymakers, financial institutions, and the public at large. By analyzing these crises in detail, we can gain insights that will help build a more resilient and robust financial system in the future. The following sections will explore several major financial crises in history, the key lessons learned from each, and the ongoing challenges faced by the global financial system. Number 1. The Great Depression of 1929, the first global financial crisis. The Great Depression stands as one of the most severe financial crises in history, starting with the US stock market crash in 1929 and spreading across the globe. Unemployment rates soared, businesses collapsed, and the global economy came to a halt. The crisis highlighted the dangers of unregulated markets and speculative investment practices. In addition, the failure of financial institutions and banks contributed to the worsening of the depression. A key lesson from this period was the importance of government intervention, leading to the establishment of new regulatory frameworks such as the Federal Reserve and the Securities Exchange Commission, aimed at stabilizing markets and preventing future collapses. Number 2. The 1973 oil crisis, economic stagnation and inflation. In 1973, an oil embargo imposed by OPEC countries caused a sharp increase in oil prices, which resulted in a global energy crisis. The price hikes led to stagflation, a situation of high inflation combined with high unemployment, which severely impacted economies worldwide. The crisis exposed the fragility of economies overly reliant on fossil fuels and revealed the interdependence of global markets. It also taught policymakers the importance of diversifying energy sources and developing alternative strategies to safeguard against future supply shocks. Number 3. The Asian financial crisis of 1997. The perils of rapid capital flows. The 1997 Asian financial crisis began in Thailand and spread to neighboring countries in East Asia, leading to widespread currency devaluations and stock market crashes. It was sparked by the collapse of the Thai baht and the sudden withdrawal of international capital from the region. The crisis revealed the dangers of excessive borrowing and poor financial regulation, particularly in emerging markets. It also highlighted the risks posed by speculative capital flows and the vulnerability of countries without strong financial infrastructures. The crisis ultimately led to calls for stronger financial supervision and better risk management practices in developing economies. Number 4. The dot-com bubble and burst of 2000, speculation and overvaluation. The late 1990s saw a massive rise in the valuation of technology companies, particularly in the internet sector, culminating in the dot-com bubble. Investors flocked to tech stocks, many of which were overvalued and lacked solid financial foundations. When the bubble burst in 2000, billions of dollars in market value were wiped out, leading to a brief economic downturn. The primary lesson from this event was the importance of distinguishing between speculative bubbles and sound business practices. It also underscored the dangers of irrational exuberance and the need for due diligence in investment strategies. Number 5. The 2007 and 2008 global financial crisis, a systemic collapse. The 2007 and 2008 global financial crisis, which began with the collapse of the US subprime mortgage market, quickly escalated into a global economic downturn. The crisis led to the failure of major financial institutions, massive government bailouts, and a severe recession worldwide. It revealed the dangers of excessive risk-taking, the lack of oversight in financial products like mortgage-backed securities, and the interconnectedness of global financial markets. The lesson here was clear. Stronger financial regulation, improved risk management, and a more transparent financial system are necessary to prevent such widespread collapse in the future. Number 6. The role of financial institutions in crisis, risk management, and governance failures. Throughout history, financial institutions have played a critical role in either precipitating or exacerbating financial crises. The reckless behavior of banks and other financial institutions, whether through excessive lending, poor risk assessment, or lack of accountability, has been a major contributor to past economic downturns. The 2008 crisis, for instance, saw many major banks operating with insufficient capital and engaging in highly risky investment practices. The lessons from these crises emphasize the need for a stronger governance, more effective risk management, and increased accountability within financial institutions. Number 7. The impact of globalization on financial crisis, spreading contagion. In any increasingly globalized economy, financial crises are no longer confined to the borders of a single country. The 1997 Asian financial crisis, for example, quickly spread beyond Southeast Asia, affecting financial markets in Europe and North America. Similarly, the 2008 global financial crisis had far-reaching consequences, with economies across the world entering into recession. This highlights the interconnectedness of global financial systems and the need for international cooperation in crisis prevention, regulation, and recovery. Number 8. The importance of government intervention stabilizing the economy. In the aftermath of a financial crisis, a government intervention is often necessary to stabilize the economy and restore public confidence. The 2007 and 2008 financial crises demonstrated the pivotal role that governments play in providing fiscal stimulus, bailing out failing institutions, and adopting policies to promote economic recovery. Without government action, financial systems can collapse entirely, leading to severe economic consequences for the population. The importance of a well-structured, timely response to a financial crisis is one of the key lessons learned from the past events. Number 9. The role of central banks in crisis management, lenders of last resort. Central banks are often seen as the backbone of a nation's financial stability, particularly during times of crisis. In response to the 2008 financial crisis, central banks such as the US Federal Reserve used a variety of tools, including low interest rates and quantitative easing, to inject liquidity into the economy. This demonstrated the importance of central banks acting as lenders of last resort, ensuring that banks and financial institutions have the resources they need to avoid collapse and keep the financial system functioning. Number 10. The social and political consequences of financial crisis, unrest and inequality. Financial crises have far-reaching social and political implications. High unemployment rates, widespread poverty, and social unrest are common outcomes of economic downturns. The 2008 crisis, for example, led to the rise of populist political movements in many countries, fueled by growing inequality and discontent with the financial elite. The social and political ramifications of financial crises show that economic stability is not only about markets but also about maintaining social cohesion and addressing the needs of vulnerable populations. Number 11. The importance of financial regulation, protecting the public interest. One of the most important lessons from the global financial crisis is the need for effective financial regulation. Without proper oversight, financial institutions and markets can easily become destabilized. Following the 2008 crisis, many countries enacted stricter regulations, such as the Dodd-Frank Act in the US, to reduce the risk of future crises. Effective regulation helps ensure that financial institutions operate transparently, fairly, and in the public interest, reducing the likelihood of reckless behavior and ensuring a stable financial system. Number 12. The need for better risk management, proactive strategies. The ability to identify, assess, and mitigate risks is crucial for both private and public sector institutions. Financial institutions must have robust risk management systems in place to assess market risks, credit risks, and operational risks, and systemic risks. The 2007 and 2008 crises revealed that many financial institutions lacked comprehensive risk management strategies, which contributed to their downfall. Financial institutions must adopt more proactive and integrated risk management strategies to prevent future crises. Number 13. The role of transparency and accountability, preventing deception and mismanagement. Transparency in financial markets and corporate governance is crucial in preventing crises. The lack of transparency in markets, such as in the case of mortgage-backed securities leading up to the 2008 financial crisis, meant that investors and regulators were unable to accurately assess the risks involved. Financial institutions must prioritize transparency in their operations and ensure that their actions are fully accountable to the public and regulations. Number 14. The psychological impact of financial crisis, fear, panic, and loss of confidence. The psychological effects of financial crisis can be just as destructive as their economic consequences. Crises often create an atmosphere of fear and panic, leading to mass withdrawals of capital, plummeting asset prices, and a loss of consumer and investor confidence. The ability of governments and financial institutions to restore confidence and reduce uncertainty is essential in mitigating the long-term psychological effects of crisis. Understanding these psychological dynamics is crucial for designing more effective responses to financial shocks. Number 15. Moving forward, building a resilient financial system for the future. The global financial crises of the past offer valuable lessons that can help in building a more resilient and stable financial system for the future. Policymakers, financial institutions, and individuals must work together to improve regulation, enhance risk management practices, ensure transparency, and foster international cooperation. By doing so, we can better prepare for and mitigate the risks associated with future financial crises, ensuring greater stability for the global economy. Conclusion. Global financial crises have profoundly shaped the course of economic history, each one offering lessons that can guide us toward a more secure and resilient financial future. While each crisis is unique, the patterns and causes of these events share common themes: lack of regulation, poor risk management, and insufficient oversight. The lessons learned from these crises emphasize the need for a more transparent, accountable, and well-regulated global financial system. By applying these lessons, we can build a financial infrastructure capable of weathering future shocks and creating a more stable, equitable global economy.